So very good evening to all of you. My name is Kishore Bagri, and I'm a volunteer at the CFA Society in the capacity of Director Continuous Professional Learning. We are thrilled to have with us today Mr. Kevin T. Carter, who is the founder and CIO of EMQQ. Kevin is a veteran in emerging market investments and ETFs. And just as a brief introduction of his, Mr. Carter is the founder and CIO of the Emerging Markets Internet and E-Commerce ETF. In the New York Stock Exchange, it is tickered as EMQQ. And he also is a chairman of the EMQQ Index Committee. Prior to EMQQ, Mr. Carter was the founder and CEO of AlphaShares, investment firm, again offering ETFs in 5 emerging markets, which was in partnership with Guggenheim Investments. In his earlier role, Mr. Carter was the founder and CEO of Active Index Advisors, which was later acquired by Natixis in 2005. And he was founder and CEO of eInvesting, which was again acquired by ETRADE in the year 2000. Mr. Carter received a degree in economics from the University of Arizona and began his career in 1992 with Robertson Stephens Company. Well, as you are all aware, the topic for the day, and Mr. Carter being a veteran in terms of emerging markets, so his presentation would provide us contours about the digital evolution within the context of emerging market, definitely. And as a context, I would just like to say that with the internet becoming increasingly affordable and accessible and having huge penetrations across the emerging markets, billions of people in the whole developing world have leapfrogged the traditional consumption patterns to consume online over the past few years. The result of this rising middle-class consumer wave has transformed economies and produced new internet giants, which have been in no way less and have been equivalent to the larger than, and have in some instances have become larger than their US counterparts as well. Not the least, but the current pandemic that we all went through and still undergoing provided an additional quantum thrust to the already significant paradigm shift of this whole digitization and digital wave driven consumption pattern that has been underway for some time now. So before I hand over, in the traditional sense, we would call handing over the floor, but in the virtual sense, before I hand over the screen to Kevin, just a few basic housekeeping points. The webinar is scheduled for 60 minutes, inclusive of question and answer session. I believe Kevin would speak for about 40 minutes, 45 minutes, and we will have 10-15 minutes of Q&A. So as mentioned, post the presentation, there will be a Q&A session where audience will be able to submit their Q&A questions in the chat box, and I will try to collaborate and present them to Kevin for the best way to address those questions. As our ongoing endeavor and effort to provide significant value addition to our members, we always value the feedback that we get from the audience. So please complete the evaluation survey, which will be coming up on your screens towards the last of the presentation. This webinar again carries a reasonable amount of CC credits. So please do log into and record the credits for attending this webinar. With ongoing efforts, do also log into our website to see what are the upcoming sessions that we have in store for you. So with that, I hand over the screen to Kevin, and intermittently, if there are something where I feel I can interject Kevin to get some more perspective on a particular subject matter on a particular topic, I think I will butt in. Is that fine with you, Kevin?
That's fine.
Yeah. So over to you, Kevin. The whole screen is yours now.
Okay, great. And thank you for the introduction, and thank you all for tuning in this evening. So I'm going to do 3 things here in my talk. First, I'm going to tell you a little bit about myself and how I think about investing and how I got involved with emerging markets. I will then summarize for you what I think are the two most important things for investors to know when investing in emerging markets. And then I'll tell you about what we do to capture what I think is not only the real growth of emerging markets, but perhaps the greatest growth story in the world today. So in terms of myself, I'm located 15 miles east of San Francisco. I've lived here my whole life, except for a few years off at college. And I've worked here in the investment business for 28 years. I started at a company called Robertson Stephens Company, which was back in 1992, the leading technology-focused investment bank here in San Francisco. And I had one interview with the firm. For the first 19 minutes of the interview, we talked about college sports. I then got a 1-minute overview of the investment business and was told that I could start on Monday. And I immediately responded, how can I possibly start Monday? I don't know anything about investing. And the person that was interviewing me said, well, go and buy this book. And he took out a piece of paper and he wrote down A Random Walk Down Wall Street. Now, some of you may be familiar with this book. It was first written in 1973. The author, Burt Malkiel, a Princeton economist. And in the first edition, it suggested that somebody should build an index fund because at the time there were no index funds. And a couple of years later, Vanguard was formed to launch the first index fund. And so this book and its author have long been associated with indexing and with ETFs in particular. Burt Malkiel, the author, was also the chairman of the committee that created the first ETF, the SPDR. So I started by reading a book about indexing, but I very quickly started to try to learn and understand what Warren Buffett and Charlie Munger did in terms of value investing. And I very much gravitated towards that approach to both investing and business. So as I tell people, I pray towards Omaha. But for the last 20 years, I've been business partners with the guy that wrote this book. So I've had one foot in the active world, one foot in the indexing world. As part of our work together, we started a company called Active Index Advisors, which builds customizable S&P 500 based index portfolios that can leave out certain sectors that investors don't want to invest in. And we sold the company, as mentioned in the lead-in, in January 2005 to Natixis Asset Management. But a few months before we sold the company, Google went public. And when Google went public, they had an investor planning day for their employees. And one of the people that they invited to speak to the employees was my partner, Burt Malkiel. Now, I wasn't involved with that day, but I heard about it from Burton the night before when we had dinner. And a few months later, somebody from Google called me and said, hey, I've heard about this active indexing you do. How can I invest? And I tried to steer him towards an advisor, but he was very insistent that he wanted to invest directly with us. And I agreed to take him on as a client. And then he introduced me to some of his other Google friends. And I ended up with 10 or 12 of these very early Google employees as clients. Now, in the meantime, my partner, Burton, has taken a great interest in China. A couple of his Princeton economist colleagues were from China and had returned to teach economics in Beijing. And after Burton's back and forth and a lot of research, they published a paper in the Journal of Investment Consulting in 2005, making the case for investing in China. The people at Google heard about this and asked if Burton could come and talk about investing in China at Google. And one day, 16 years ago, we drove down to Mountain View and Burton gave his talk about China. And all of these people at Google looked at me and said, we want to invest in China. Now, I didn't know what that meant really, at the time. I had never been to China, but somehow from the moment that that talk ended until today, my entire life has revolved around trying to figure out what does that even mean to invest in China and how should somebody go about doing that. So with that long lead in, let me tell you what I've learned in those 16 years. So first of all, when we talk about emerging markets, in terms of the population, in terms of the market cap, in terms of GDP, we're talking about a story that's about 60% Asia, with China and India being the largest of those countries. We're talking about 20% in Central and South America, with Brazil and Mexico being the largest economies there. We're talking about 10% in Africa and also 10% in Eastern Europe, led by Russia. So that's what we're talking about geographically. And fundamentally, what we're talking about is the world. We're talking about most of the world's people, about 85% of the world's population. And we're talking about even more of the future as measured by young people, those under the age of 30, for which emerging markets account for about 90% of the world. Now, the GDPs of the emerging markets have been growing on average at about twice as fast as the developed world GDPs. As the left side of this slide shows, their GDPs are now bigger than the developed world GDPs. But on the right side, you'll see the emerging markets share of a number of different categories, three of which I've called out with red arrows. The top one showing you again that the vast majority of the world's people are in emerging markets. But the bottom two red arrows are showing you that in the categories of consumption, retail sales and consumer spending, emerging markets are way behind. And it's the difference between that top red arrow and those bottom two red arrows. That's lesson number one. The thing that is emerging are the people. Billions of people are moving on up and they want stuff. They want more and better food, more and better clothing. They want appliances, entertainment, vacations, cars, and they want their kids to go to college. And that's the story. I didn't have to figure this out. It was very well documented when I got involved. And you can see here on this slide at the bottom that McKinsey & Company concludes that not only is this a big deal, but it's, in their opinion, the biggest growth opportunity in the history of capitalism. So it's what all investors in emerging markets should be focused on. And ultimately, it's what EMQQ is all about. So we'll come back to this part of the story. Now, the second thing that I tell people they need to understand about investing in emerging markets, and in particular using index funds and exchange traded funds to invest in emerging markets, is that there's a real problem, I think, with the traditional approaches. And this is something that I learned in the first 5 minutes after the Google talk when we got back to the office in San Francisco. So when we got back, I walked straight over to our investment team and I said, the Google guys want to invest in China. Give me a list of all the companies in the China ETF, because I assumed that we would use that to give these people exposure. And before they gave me the list, my partner pulled me aside and he said, look, when you get the list of all the companies in the China ETF, you're going to see that most of the companies are government-owned banks and oil companies, SOEs, state-owned enterprises. And I said, yes, I've heard about this. And he said, let me give you an example of how these companies work. And the example was this. He said, you've got a Chinese manufacturing plant that's been losing money for 10 years, and it's about to run out of money. It also has 15,000 employees. The management of the company goes to the state-owned bank in town and says, we need more money. Now, a normal banker would say, no, you can't have any more money. But the state-owned banker doesn't say that. The state-owned banker says, well, if you run out of money, then there'll be 15,000 people that'll be unemployed, and they will all go out to the streets to protest. And so the bank decides to make another loan. Now, that made me literally sick to my stomach, because in my simple Omaha brain, earnings equals value, and the growth of earnings equals the growth of value. And if the people that run these companies don't care about that, why would you invest in them at all? And in the case of the China ETF back then, it was over 80% state-owned enterprises and less than 10% in consumer stocks. For the broad emerging markets indexes that the largest ETFs and mutual funds track, these state-owned enterprises are about a third of the index. And the best example of what's wrong with these companies is the Brazilian oil giant Petrobras, which was systematically being looted of billions of dollars by the people that run the country, including a large percentage of their congressmen and the last two presidents of the country, both of whom went to jail for basically stealing your money if you're investing in these broad emerging markets ETFs that have about a third of their money invested in these SOEs. Now, the problem is even worse if we count two other groups of companies, the former Soviet state-owned enterprises, now controlled by the oligarchs, and the chaebol in Korea. If we counted those two groups of companies, the index is about half in these types of things. And these companies have a lot of the same problems, including corruption and people going to jail, like these two. Portrayed in masks on this slide, you see a gentleman in the middle. That's the former chairman of Samsung. He went to jail for bribing the woman pictured to his side. That's the former president of Korea. So these are really troubled companies. And it's for this reason that I concluded a long time ago that if investors want to invest in emerging markets and they want to make money, they should avoid the traditional approaches, and they should do what I saw happening in the Ivy League endowments in my first several years focused on China. So once Burton and I got focused on China, we worked with Guggenheim to launch a number of China ETFs. But when I wasn't working with the Guggenheim people, I spent most of my time in New York City and Boston with a couple of dozen family offices and foundations and endowments. And I watched how they were evolving their approach to emerging markets. We call this Emerging Markets 3.0. Now, it's pretty simple. You start with a toe in the water, small allocation. You can see Harvard's 2005 allocation plotted here. And these investors were slowly increasing their allocation. But once they started to get a meaningful allocation, a 10 or 15% allocation, and they've seen that they haven't really made the money they thought they would make, they decide that they need to get a little bit more precise in how they approach. And in the case of someone like Yale University, what they did is they took a Chinese graduate who was working for the endowment, and they seeded him with $50 million and said, go back to Beijing and invest this for us in a smart way. But most investors didn't have access to that type of an approach. And so what I started to tell people was, look, just buy the consumer stocks, leave out the legacy economy, leave out the oil, leave out the banks, leave out the corruption, and just go where the real growth is, the emerging market consumer. Now, here in the United States, there's an ETF that tracks the emerging market consumer ETF. It has the ticker in the US of ECON, Econ, the emerging market consumer ETF. And it owns the 30 largest emerging market consumer stocks, according to Dow Jones. Now, I have never had anything to do with that fund, but I knew that it existed. And when people asked me what the best way to invest in emerging markets was, I always told them to buy Econ. Now, about 7 years ago, I woke up one day and I looked in the mirror and I thought, oh my gosh, what have I done with my career? I was this young, cocky stock picker, Charlie Munger, Warren Buffett wannabe, but somehow I got mixed up with this Princeton guy and Vanguard board member, and now I'm building Chinese index funds. And I've obviously lost my way and I need to get back to my roots. And so I told the Guggenheim people I was going to do that. And I set up an investment partnership for myself. And once it was organized and funded with my own money, I invested it in 5 stocks, all of which were part of this emerging market consumer story. And after I had myself invested, I thought, well, I should at least go see if any of my friends want to invest with me. And so I scheduled some meetings. And the day of those meetings, I made a few slides to show the people I was going to meet with. And one of the slides was a list of the 5 companies I had invested in. The first three companies were in the emerging market consumer ETF. Those three stocks trade in Hong Kong. They were Want, the Nabisco of China, branded crackers and snack foods. The second and third companies, Chinese sportswear companies, Li Ning and Peak Sports. You can think of these as the Reebok and Converse of China. But then I had two other investments, two other stocks I owned that were clearly part of the emerging market consumer story, but in the database, they were not called consumer companies, they were called technology companies. The first one on the New York Stock Exchange was Wuba, 58.com. This is the Craigslist, the local advertising leader in China. And the fifth and final company trades on the NASDAQ. It has the ticker MELI, Mercado Libre, which is the e-commerce and digital payments leader in all of Central and South America, with its biggest market, Brazil. And after I made that list, I looked at the stocks and I thought, these consumer companies are great. They're growing fast, 15 or 20%. They have good margins. But then I looked at the two other companies that were obviously plays on the consumer, even though the database called them technology companies, and they were growing at literally 100%, 7 times as fast, and had very high margins. And I just remember thinking, these are the two best companies I own to invest in the growth of consumption in the developing world, and yet they're not part of the emerging market consumer ETF that I tell people to buy, because the database has put them in a different box. And that was it. I had that thought. I printed my slides. I drove around town and had my meetings. And on my way home, my telephone rang. And it was a friend of mine who had a 3-year-old daughter. And my friend said, "What's the best emerging markets ETF for my daughter's college fund?" I started to tell her to buy Econ because that's what I normally told people. But then I had an idea pop into my head. And I thought, wait a minute, the best emerging markets ETF for long-term investors doesn't exist. And I immediately went back to my office that day and I started to organize EMQQ, and it launched 3 months later on the New York Stock Exchange on November 12th, 2014. So now let me tell you how to think about EMQQ. It wasn't as clear to me then as it is now. I saw the incredible growth rates. I saw the profitability, and I saw that while the PE multiples were higher for these companies, the PE multiple divided by the growth rate, the PEG ratio, was in fact lower and quite reasonable for these companies. But what I didn't see was that there are 3 mega trends happening in the world today that are creating what I think is the fastest growing sector in the world. Not just today, but perhaps ever. Now, those 3 megatrends are things that we here in the United States take for granted. 3 things that have been part of our lives for a long time that are just reaching the rest of the developing world. The first of those so-called megatrends is this one. We've already covered it. Billions of people moving on up and wanting stuff. Now, when I got that phone call 7.5 years ago, I answered it on my iPhone. I had one by then, but I had only had it for a couple of years. It was still pretty new to me. But I was already seeing how it was affecting my family's consumption. Back then, my family went to this store 4 or 5 times a week, which was very easy to do. We have a car, the roads are nicely paved, there's free parking. But all of a sudden, the trips to this store started to go down. And this guy was at my house once a week, and then twice a week. Now, even before the coronavirus came to town, my family had stopped going to this store, except for maybe once a month. And this guy and others like him were at my house 20 times a week. So if we think about how this device has changed our lives, and we map it over to these people, billions of consumers in the developing world, the story gets really big. Because while I've had a computer for 30 years, the smartphone was not my first computer. The reality is that in most of the developing world, people haven't had computers before, and they never are going to have a computer if we're talking about the one that I'm looking at on my desk. So the second mega trend is the computer. It's coming in form of smartphone, and it's not running on, it doesn't have an Apple logo for the most part. We're talking about our Android-based smartphones selling for $50, $80, $100. They're made in China by Oppo, by Vivo, by Xiaomi. They're getting better and more affordable every year. And they're bringing with it the third mega trend, something that I've had here in San Francisco for 25 years called the internet. Now, when I first got internet access in 1995, it was over a telephone line. Then it was over the cable. Now the internet shows up in my pocket wherever I am. But the reality is that most of the developing world was never wired. And so as these billions of consumers get that first computer, they're also getting their first internet access, and it's changing their lives forever. You can see here that it's still pretty early. In countries like yours, the smartphone penetration is way behind what it is in the developed world. And thus, there are still a couple of billion people in emerging markets that don't have a smartphone, because if you're, and don't have a computer, because as you know, in Western China or in India or in Nigeria, if you don't have a smartphone, there's a very, very high chance that you also don't have a 30-inch Mac from Apple on your desk. So those are the three trends: billions of people getting their first computer, their first internet access, and importantly, because of a lack of consumption infrastructure, they're leapfrogging to digital consumption, and the result is this. This is the most important slide in this presentation, fundamentally. What this is causing is massive growth. This is showing you here, the blue bars, the revenue for the emerging markets internet sector for the last 10 years, with the 10 years ended with 2019. And you can see that the 10-year average growth rate was 38%. Now, that is not easy for any company to do, let alone an entire sector. And I am not 100% sure of anything in the world, but I have given this presentation to probably about 80 CFA societies around the world now, and hundreds of other professional investor groups. And I've offered cash rewards to anybody that could show me a sector that's growing this fast or has grown this fast in the past. I've asked everybody I know who's smarter than me and more experienced than me, and so far my inbox is empty. So I'm not positive, but I'm pretty sure that this is not only the fastest growing sector in the world today, but likely the fastest growing sector in the world ever. Now, what comes with that? Value creation. So you can see here over the last 11 or so years that the blue line is showing you that the internet companies have done quite well. Meanwhile, in yellow along the bottom, you can see that investors in the traditional broad indexes haven't made very much money at all. And to the extent they have made money, it's only been in the last year. And if we made this chart a 13-year chart, you would have just got back to break even in the last few months. So a lost decade for the legacy economy, but a fantastic decade for the internet companies in the developing world. Now, Alibaba is our poster child. This is, really not much of a surprise. The largest IPO in US history was a Chinese internet company, of all things. And let me point something out. Most of these companies have historically listed in the United States. They're being founded by local entrepreneurs, but they're getting funded by US institutional investors. Here's a couple examples. You had Alibaba get a large investment from Yahoo, which turned $1 billion into $50 billion. And in my personal favorite story from the last couple of years, this Brazilian fintech company Stone came public here in the US, and my heroes in Omaha bought 5% of the company on the IPO, which I believe was the first ever IPO investment for Berkshire Hathaway. And the point of this is that corporate governance is your biggest problem in emerging markets. These companies, you'd have to say on an absolute basis, have very good corporate governance. And on a relative basis to things like Petrobras, you'd have to say they have fantastic corporate governance. So an important side benefit to these companies. Now, Tencent is the other so-called super app that's part of EMQQ. It's actually the largest company now by market cap. It's bigger than Alibaba presently. They've been sort of neck and neck for a decade. And it's not as well known in the US as Alibaba. And to make it simple, I'm sorry?
Can I hold you for a second here and pull you back to a couple of slides back where you kind of outlined the 10-year growth story of the revenue growth as well as the stock performance growth of the EMQQ index for the past 10 years, right?
I'm sorry, you want me to go back to this?
Yeah. So a phenomenal return trajectory over the past 10 years is what you have demonstrated as far as the EMQQ index is concerned, right?
Yes.
So my question here is that given the phenomenal return in the past 10 years that we have seen, and I think a big blip has come over the past 2 to 3 years of this return, though quite consistent, but the past 2 to 3 years have provided a strong thrust to the overall returns. So how sustainable are these kind of returns, let's say 5-6 years down the line from here on, number one? And secondly, as far as the revenue growth that you projected for your index composition, just out of curiosity, was it a skewed revenue growth contributed by a select few of the companies, or was it evenly distributed? And how sustainable could be the revenue growth as well? So 2-3 questions mixed up together so that we can address for the benefit of the audience.
Sure. Well, the revenue growth, the growth rate will slow. It has slowed, but off of very, very large numbers. The growth rate for 2020 was only 25%, but if you consider the state of the world, 25% pretty darn good in a regular year, let alone during a pandemic. And the revenue growth estimates for this year are 35+%. So now that will come down. This is the law of large numbers. When I got involved with China, it was growing at 11 or 12%, but it's slowly gotten, the growth rate's gotten lower, but the absolute amount of growth remains bigger. And so I think that the average growth rate will, this year we'll get a good bump as a sort of rebound year, but after this year, I think we'll expect growth rates in the mid to high 20s for the next couple of years after this year. And so it will, the growth rate will slow for sure, but it will still be, I think, the fastest growing sector in the world today. And in terms of returns, it's all about valuation. The fundamentals are one thing, but the price tag is also very important. And as I mentioned earlier, the only ratio I care about is the PEG ratio, the PE versus the growth rate. And as I'll show towards the end, the PE to the growth rate is still very reasonable. It's half the valuation of the US tech leaders, and it may be only about 25% of the PEG ratio of the S&P 500. So, we've had volatility in the past, we'll have volatility in the future. Some of that will be negative volatility as we've experienced in the last 4 weeks, but I think that the going forward decade looks very, very good. And a lot of that has to do with your country, where the Generation Z is coming online fast, and they're even more digital than my teenagers. So I think the outlook is very good, but not without volatility. And one of the reasons that I remain bullish is because, when we talk about these companies in the developing world, the e-commerce companies, we can call them tech companies, but they're really consumer companies that are empowered by the smartphone. And So, historically, when people said, well, what's Tencent? We said it's the Facebook of China, and that's a fair comparison. But the reality is these companies don't have a US equivalent. And the reason is, as I mentioned earlier, the consumption infrastructure in the developing world is undeveloped. And when I say consumption infrastructure, I'm talking about bank accounts with debit cards in people's pockets. I'm talking about televisions on the wall that have 1,000 channels coming in through them via cable. And I'm talking about stores like Walmart and Target. Because those things don't exist, it's allowing a lot of these companies to go into every consumer vertical and compete. That includes healthcare. Alibaba's healthcare company is now a separate publicly traded company. Tencent will probably IPO its telemedicine business, WeDoctor, soon. JD.com IPO'd its healthcare business in December. So these companies are digitizing healthcare. They're digitizing entertainment. The leading music app in China is, in fact, Tencent's TME, trading here on the New York Stock Exchange. These companies are in grocery stores. Alibaba's Hema Market, pictured here, is the most amazing thing I've ever seen in China. And they're digitizing the financial system, which is the biggest part of the story, and the story that's showing up in the streets and in the financial reports. And you know this better than we know this here, but the digitization of payments is the kind of the gateway to all financial services going on the phone. As you know, in China, you can't go anywhere to buy something without finding the QR codes pictured here from Alibaba and Tencent. And the same day that I took this photo, I tried to buy a bottle of water in the train station in Nanjing. And when I tried to hand the man a Chinese banknote, he told me, no, I couldn't have a bottle of water. Meanwhile, up on the streets, I could buy anything with a QR code. And this is a very big deal in the developing world. You can see that in China, Alibaba and Tencent now have the money. And once you have the money, you can get into the investment business. Alibaba actually announced this week that they now have 100 million subscribers to their wealth management platform that they launched with Vanguard. You can get into insurance and you can get into credit. And it's the credit part of the story that has gotten Alibaba and Tencent a little messed up with the Chinese regulators. So it's sort of a paradox. You would think that someone like me, a fintech entrepreneur here in San Francisco, that I would be on the cutting edge of mobile payments, but it's not me. It's the developing world that's way ahead of the developed world in this. And for example, in Africa, Kenya, their mobile payments market is now twice the size of their gross domestic product. So fintech is the biggest sub-story here, and that's going to go on for a long time. Other geographic examples, this is Mercado Libre, one of the companies that inspired EMQQ, trading here on the NASDAQ. This company has been one of our best performers over the last couple of years, largely because of the fintech business. Eastern Europe, the Google of Russia, is also now the Uber of Russia, having beaten Uber in Russia. Uber now is a minority stakeholder in YNDX Taxi, which will probably IPO sometime soon. And there's a lot more coming, and these smaller companies have faster growth rates than the larger ones. So a lot of the growth going forward is going to be driven by the smaller, not Alibaba and Tencent, but the other up-and-comers like Ozone, like the Polish e-commerce leader, Allegro, which recently IPO'd. Now, in India, this is where we're most excited going forward. We wish we had more exposure to India, but there's only a few publicly traded internet companies so far. But we think that starting this year, that the unicorns of your country will start to IPO. The first one we hope to see is FLIPKART, which, as you know, was acquired by Walmart a few years ago. But our sources are indicating that this company very well could get IPO'd this year. And finally, Reliance Jio, which I find to be the most fascinating company in this story today, and I don't need to tell you what's going on with Jio, but of all the companies in India that I think have the best chance of super app status, I think it's Jio, and we would love to see the people at Reliance IPO Jio, and we suspect they will. Africa, this is the Nigerian e-commerce leader, Jumia, which trades here on the New York Stock Exchange. So there's lots of opportunity all over the world. Even Kazakhstan now has its first publicly traded e-commerce company, Kospi, trading in London. And then the other thing I would point out is that in addition to the 96 public companies that are part of EMQQ, you also get exposure to hundreds of private companies, not because we invest in them, but because companies like Alibaba and Tencent are also very, very active venture capital investors. A couple examples that I like to feature. This is DIDI, the Uber of China, which is looking like it will IPO sometime perhaps in the next 12 months. Alibaba and Tencent are both investors in DIDI, as is Apple. And as you know, DIDI is also an investor in Ola Cab. So you get exposure to DIDI. And my favorite example in India, PAYTM, which Ant Group has a very large ownership stake in. And I like to feature it because my heroes in Omaha are also an investor. So this is a story of growth. The growth rate will slow, but it's still, I believe, going to be the fastest growing sector in the world as these three mega trends combine at the same time. Side benefits, importantly, in a part of the world where governance is the real problem, you get good corporate governance. And you also get a lot of exposure to not just emerging markets, but frontier markets like Nigeria, and to private companies like DIDI and PAYTM. So this is a growth story. Obviously, the pandemic has been terrible for the world, and I've been worried from the beginning about the very dense parts of emerging markets where sanitation and social distancing are not, well, sanitation is perhaps not great, and social distancing nearly impossible. And that suffering continues. China's had a lot of advantages in handling this, and they've been able to keep the thing largely bottled up and minimize the outbreaks to hundreds of cases and not tens of thousands of cases. Their GDP, in fact, grew last year, and they didn't have to throw as much money at the problem as we did here in the US. So China's been a winner in this. And China's 2/3 of the EMQQ story, so that's favorable. And then the other thing that's uncomfortable for me to talk about, but the reality is that this coronavirus has done nothing but really stimulate most of the parts of the EMQQ story, with the obvious exception perhaps of travel. So that's been one of the reasons we had good performance last year. But the story was already a very good growth story to start with, and only accelerated by the pandemic. Now, the big news here with investors that are concerned in the last several weeks has to do with regulations in China. And that started in early November when the Ant Group IPO was canceled. And to be honest, I think the regulators were right in canceling this IPO. I think that the business really did need a review, and the regulations needed to catch up. The real problem there again was the credit part of the business, where Alibaba was originating a lot of credit. 500 million people in China had used the Ant Group app to form some sort of credit. So I think the regulators are right there. I think the antitrust and monopoly issues probably have some real merit to them, but I don't think the Chinese government's looking to squash these companies, only to maintain a regulatory environment they're comfortable with. And these companies have also been under attack from the US government. So the bottom line is these companies, particularly Alibaba and Tencent, have been under siege And I think the tensions between the US and China will continue, though hopefully with a slightly better tone. And now going back to the valuations and the outlook going forward, you know, right now the PE is about 40 for these companies, maybe a little lower. And you can see up above on the right side there, the growth rate for the year is expected to be over 35%. So 40 divided by 35 gives you a PEG ratio that's a little bit over 1. And meanwhile, the US tech leaders, the FANG stocks, have a similar PE, but half the growth rate. And as I mentioned earlier, the S&P 500 might have a PEG ratio of 5. So 4 times this group. So I don't make short-term stock market predictions, but for long-term investors, those with 3 years, 5 years, 10 years, I think in spite of our strong past returns, I think investors can expect to do very well going forward also. So in terms of our approach, this is very straightforward. We own all of the publicly traded emerging and frontier market internet companies, as long as they meet our minimums for size and liquidity. And we rebalance twice a year in June and December. So that concludes my comments, and I'm happy now to answer any questions or take any comments.
Well, thanks, Kevin, for this very enlightening session on the emerging market and the whole digital story that you outlined. A few questions immediately leading out from the last slide that you just presented. If you could just throw some more light on the construction of your whole index in terms of weightages and how do you go about it? Is it just market cap weighted or how is it?
Okay, so you know, any company in the world that generates more than half of its revenue from internet or e-commerce activities in emerging or frontier markets is included, as long as it meets our market cap minimum of 300 billion and our average daily volume of $1 million US. Now, that might seem pretty simple, but you know, one of the things I've become very suspicious of is the quality of data in the databases. So we don't care what country your stock trades in, and we don't care what country you're domiciled in. What we care about is where does the money come from? And those don't always match. I think one thing that I've really experienced in the last 15 years is the databases they're troubling when you use them, you know, for without looking, you know, without opening the financial reports and seeing what these companies really are. And the reason I was so troubled by this, you may recall that I used to recommend people invest in the emerging market consumer ETF, and I went through all 30 of the companies in the ETF. And the first 2 companies, the 2 largest positions, were both about 10% each. So about 20% in the first 2 largest companies. Both of them said they were South African consumer companies, but one of them called Naspers was really a Chinese internet company in disguise, because their entire value is 10-cent shares. And so it's really a Chinese technology company, even though the database said it was a South African newspaper company. And then the other company from South Africa was Steinhoff International, which is a furniture company that is headquartered in South Africa, and it does trade in Johannesburg, but all of the people buying the furniture are in Europe. So we don't care what the database says you are, we care what the money says you are. And then it is market cap weighted when we do the rebalance in June and December. But it's got one modification, which is we limit the largest stock to 8%. So, and the reason we do that is Alibaba and Tencent are so much larger than the other companies that they would be about 40% of the fund between those 2. So to limit those, we put a cap of 8%. The stocks move around between the rebalances, and so you'll find some of the smaller companies usually by the time we get to the rebalance, one of the other ones will have leapfrogged up and be 9 or 10%, and then it'll get sold back down at the rebalance.
You yourself highlighted about the issues which came up in China regarding IPO. And
I'm sorry, can you speak a little louder?
you yourself alluded to the fact about regulatory issues regarding the IPO, and similarly, these very, very large companies creating very, very monopolistic kind of situations can have crosshair situations with a lot of governments. Even in the recent past, we saw Google and all those companies having tips and tussles in Australian regulatory environment and the other markets as well. So what are your thoughts on these kind of skirmishes that may come in given their monopolistic situation, and any kind of repercussion that may backfire from a government regulatory aspect?
Okay, well, the Ant Group IPO, was really fascinating to me, and I was worried about the IPO, to be honest. I was excited originally because, as I said earlier, the fintech, the financial technology part of the story really is the fastest growing part of it, and Ant Group would have been the proverbial flag in the ground for fintech. So we were excited by that. The company's financials were amazing. The company was very big, it was growing very fast, and it was very profitable. But what I got concerned about was the frenzy to buy the stock in China. You had a $30 billion offering that had $3 trillion of orders placed to buy it, almost 1,000 times how much was available. The brokerage firms were offering a large amount of leverage. You could put down 5%, so essentially 20 times leverage to buy the IPO shares. And the stock was going to trade both in Shanghai and in Hong Kong. And there's about 100 companies that are listed both in Shanghai and in Hong Kong. And but as you know, it's not easy to get money in or out of Shanghai. It's a little easier than it used to be, but it's still limited. And you also can't short in Shanghai. And so what's happened is the companies that trade both in Shanghai and in Hong Kong don't trade at the same price. And historically, they've traded at a significant premium in Shanghai. And because there's 700 million people in China that use Ant Group every day, a lot of them using Ant Group to buy stocks, I was very worried that the demand in Shanghai would drive the price up to a potentially absurd premium over the Hong Kong share price. And that poses a lot of questions about market caps, right? What's the market cap if the price is different in Shanghai than Hong Kong? So in many ways, I was glad that the IPO was pulled. And initially, I really saw it as this perfect sort of 50-50 balance between the hard-charging Ant Group and the regulators who need to regulate. And so I saw both sides. But the more that I've thought about it and studied it and contemplated it, I think the government had to stop it, because the reality was that Ant Group was very quickly becoming the Chinese financial system. I mean, you had 700 million people that used this all day long. And while originally Ant Group was competing with the existing financial services companies, they, in 2008, sort of pivoted the business to enable the existing financial service companies. And so they've been selling other people's mutual funds and insurance products. But the real problem was the origination of credit, where they were originating loans and pushing those loans out onto the banks and not reserving much, if anything at all, on their own books. And so they wanted to act like a bank, but not be a bank. And I think, and it was happening very fast. I mean, it was the scale of this and the speed with which it was growing were both incredible. And I think that the government really did have to slow this thing down and make sure that they had measured twice before letting this thing continue to run. So it's definitely going to impair the valuation of Alibaba's fintech group Ant, and also the other fintech operations of JD and Tencent, but it's not going to kill them. I don't think the Chinese government wants to squash them completely, but it's definitely going to slow down their growth and/or decrease their profitability. So that's that. And in terms of, I think the second part of your question had to do with the antitrust and monopoly questions that have been also circling, and these things are also, I think, legitimate on both sides. I mean, Alibaba and Tencent, as I talked about, they have hundreds and hundreds of other internet companies that they have funded and own parts of, and I think that very clearly part of their thinking in those and their strategy in those is to help those companies along, and it seems that it probably is true that some things have been done that are, you know, close to rubbing up against the antitrust and monopoly laws, which are not unique to China.
Yeah. So this whole technology-driven companies do face technological challenges from some disruptive, innovative technologies from some of the startups or something. And
can you speak a little louder? I'm sorry, I'm having trouble hearing.
Is it better now?
That's better, yes.
Now, since this whole business of digital and technology driven is based on a lot of technological innovation, and a lot of small companies and startup companies kind of can bring a lot of disruption in terms of bringing new technologies. So how prepared or strict are these well-entrenched players to adapt to the new technologies or change themselves fast? Or is it going to be their wherewithal and financial power and they buying out any of the innovations that are happening? How is it going to play out in your view?
Well, you know, we've seen some of the upstarts compete very well, and there's no doubt about that. I mean, you had maybe the best example of that is Pinduoduo in China, PDD, which now has more customers than Alibaba. They don't spend as much money, so the revenue is not nearly as great, but Pinduoduo has definitely come out of nowhere and taken a meaningful piece of the Chinese e-commerce market, and that's, you know, Alibaba's market share continues to decline, but the whole market is growing still quite rapidly. So they're still, in the case of Alibaba, been able to maintain a growth rate of over 30%, and so innovation will continue, but and it's happening both within the Alibabas and Tencents, and it's also happening outside. ByteDance, Meituan, PDD, these companies have, you know, challenged and challenged successfully the incumbents. And then you also have Baidu, which, you know, in many ways should be the largest of these companies, but they didn't innovate, at least in the e-commerce direction. That company's done a little better recently. The market seems to think that their artificial intelligence and autonomous vehicle technologies that they have invested in are going to bear some fruit at some point, but they've certainly left a lot of opportunity on the table over the last decade.
Just before I get on to the next question, I request to the audience to please fill in the feedback forms that must have popped up on your screen, please. This will help us increase our learning endeavors on an ongoing basis in terms of what kind of content and what kind of speakers we do for the benefit of our members and audience. One of the questions that I had in mind was, how much of an allocation do you think is kind of optimal or appropriate for emerging market allocation for any investors? Now, I understand that investors from emerging markets like India will obviously have a home bias, and most of them would already be having 100% investment only in the Indian markets per se. But having said that, in general, what could be your advice in terms of allocation or exposure to overall emerging market investment opportunity?
Yes, okay, great question. So as you pointed out, I think most countries have a home country bias, and that's a natural thing to have. Here in the US, what we find is that investors have somewhere between 5 and 15% invested in emerging markets, and with the average, particularly with financial advisors that we talk to, maybe an 8% sort of average allocation. And you know, I've seen 100 people ask this question to my business partner, Bert Malkiel, who's, again, quite a bit better educated and pedigreed than myself. And the only answer that I've ever seen him give is more. When people say, how much should I have in emerging markets? He says more. And I kind of agree with him, but here's what I would say, and I'm obviously biased, but if the question is how much should you invest in the traditional broad emerging markets indexes that almost everybody uses, I would say less, because I don't think you're going to make much money in those because of the problems I detailed. In terms of EMQQ, you know, when we launched the fund 7 years ago, when people would ask me how to use it, how much to put in it, I would always tell them to use a core satellite approach. So buy the Vanguard Emerging Markets Fund, the big one, as your core, and then use EMQQ as a satellite along with it. But I didn't really feel that. I said that because I knew it sounded easier for an advisor to approach it that way. And very quickly, what I would say is, you can do that, but you'll have less money in 5 years, which is basically how I feel and still feel. And the other thing that has happened with me particularly the last year is I've really just started rethinking asset allocation and modern portfolio theory completely. And part of the reason had to do with our own company's 401k plan. I have 4 employees now, but you know, a year ago I had 2, and their average age was about 30. And so, you know, a retirement, a 401k plan here in the US is, you know, that's retirement money. So these are people that had a 30-year investment horizon. And as I looked at the choices they had in the 401k plan, and EMQQ was not available, I started to think about it, and you know, if you have a 20 or 30-year time frame, I can't think of a better thing to put your money in than the internet companies that are public and coming public in places like your country and Africa and all over the developing world. So I'm very biased, but I can tell you that I have approximately 100% of my own money in the emerging markets internet space.
Another aspect that comes to mind is India in particular. I don't know how closely you have evaluated or studied the Indian market per se, but still the passive or index or ETF style of investing is very, very early days, even after the world has moved towards index and ETFs in a big manner, particularly the US markets, etc. So any thoughts on that? And do you think any potentiality in terms of growth of these index ETFs, customized ETFs, index, as far as the Indian market per se is concerned?
Well, to be honest, I'm not I'm not very familiar with your marketplace for investment products. Clearly, the United States has been, very much in the lead on the ETF shift, and that's a very big shift, and a shift that's not going back. And our entire investment marketplace is just a giant wave of money going into ETFs, and that's good, but it's also lost a little bit of its true value. I mean, the reason that index funds and ETFs were getting traction at all was because of the fees, right? And there's pretty simple mathematics in the world of investing, and the less you pay other people, the more money you're going to have for yourself. And what made the Vanguard funds and the ETFs attractive versus the traditional active mutual funds is that you were pretty much guaranteed you're going to make more money with a fund that charges no fees than any of the funds that charge 1.5%. And now, having said that, that's what opened the gates for ETFs. But now that's changed. Not all ETFs are made by Vanguard, so they're not all very, very low cost. And so now ETFs got in the door in the United States because of their low fees. But now that they're in the door, there's all sorts of people putting together funds that don't have Vanguard level fees. And but back to your market, I don't know. I assume it's not as well developed as our ETF market is, obviously. And even markets like Hong Kong, we're exploring listing in Hong Kong, and their market had very few ETFs compared to the US. So I think in all of the developing world, I think the offerings are still pretty early.
One thing that I realized looking at your composition of the ETF is it's not just a traditional way of creating ETF, as you have been repeatedly pointing out yourself, but looks more like a selection of theme and then bottom picking of the stocks and then assigning a weight to risk manage them. Is that what you would say a fair statement, or you have some other views on that?
Well, we're not picking the stocks per se, if that's what you were asking. I mean, it's a rules-based index, our approach, and we do study our companies a bit more than most indexing people do. I mean, again, I'm a Omaha person, so I like to look and see what we own. But it's about as active as it can be while also being index-based. But the lines on that are even blurring here in the U.S. And now we have truly active ETFs popping up, and Kathy Wood and the ARC people obviously leading the charge on that. So active ETFs are coming, but I don't think the traditional active managers are going to win in the active ETF space here.
So I think we don't have any further questions from the audience, and we have also exceeded the time limit. So with that, I will take the opportunity again to thank Kevin for his very, very enlightening and enthralling session. I'm sure the audience got a great insight in terms of the emerging market, and particularly the digital theme and the ETF and index that you provide as a avenue for investing in that particular theme. So with that, thanks a lot, Kevin, once again. And thank you, audience, for taking the time out to hear us out and particularly have this whole session being curated for you. Again, one slight request to those of you who have not filled up the feedback form, please do so before leaving. So with that, thanks, Kevin, and look forward to having a similar session in future again. Thank you so much.
All right. Thank you all for tuning in, and thank you for hosting, Kishore. And by all means, if anybody would like a copy of our slides, we'll make sure they're available to you, or you can reach out to us via email.
Thank you so much.
Thank you.